hosted by 3 and 4. We're going to begin starting our webinar now. Quick little bit of housekeeping. Everybody's in listen-only mode. So what we're going to do is at the end of the session, as you have questions, you can feel free to use the GoToWebinar dashboard to type in questions, and we will go through them and respond to every question that we can. Today's webinar should last about 30 minutes and change, depending on how many questions that we have. I'm going to hand it over to Jonas Roser to kick us off, and we'll get started.
Chris, can you hear me?
Can hear you just fine, Jonas. Thank you very much.
Okay, great. Well, thank you, everyone, for attending and being a supporter of the 3 and 4 Association. I'd like to bring some focus to Chris and his company as an advisory board member and one of our first sponsors. Chris has been really crucial into supporting the 3 and 4 brand. As you know, we are a nonprofit, and what keeps us sustainable is members such as yourself and sponsorships from other companies within the industry that provide products and services that should be considered when forming a long-term care plan. So I'm very happy to introduce Chris, and Life Care Funding is a great product you should consider when you're out in the field and listen about, to talking to people looking for other options when forming their plans. Chris Orestes is the CEO of Life Care Funding. He's an 18-year veteran of both the insurance and long-term care industries. He's a former Washington, D.C. lobbyist. He's a nationally known senior care advocate and the author of Amazon's best-selling book, Help on the Way. He's a legislative expert. He's a featured speaker. He's a columnist and a contributor to a number of insurance and long-term care industry publications. Chris is a frequent guest about senior issues on national radio programs and has been featured in just a number of magazines and media, from the Wall Street Journal to the New York Times to USA Today, Fox Business News, and PBS. Life Care Funding was founded in 2007 and is the pioneer of the concept of converting a life insurance policy into a long-term care benefit. Since the company's inception, they have built a national network of agents, attorneys, and advisors, as well as over 5,000 home care, assisted living, and nursing home companies that offer the long care benefit policy conversion option to families directly across the United States. So I'd like to introduce Chris, Life Care Funding, and take it away, Chris.
Jonas, thank you very much. And again, thank you, everybody, for taking time out today to be on today's webinar. It's a real pleasure for me to have a chance to work with 3 and 4 and present this session, and particularly to this audience. Your agents, your advisors, your experts in the field of long-term care and long-term care planning. And here is an option that you will be in a position to talk about that helps families address immediate need for long-term care. This is a funding option that is not a competitive option to long-term care insurance. It's very much a complementary option. It's taking an existing life insurance policy of any form and turning that into a vehicle that will be able to pay for long-term care services today and cover any form of long-term care: home care, assisted living, skilled care, hospice care. Our company was founded in 2007 with the mission to help seniors take an unneeded life insurance policy and use that as a tool to pay for long-term care. Since our company was founded, it's been adopted and is offered by literally thousands of assisted living communities, home care companies, nursing homes across the United States as an option to help them pay for care, help families pay for care that want to use their services. It's also a program that has now been adopted by agents, attorneys, financial advisors across the country, and something that you'll be able to use as well going forward after today's session. I'm going to start by addressing the obvious and the reasons so many care providers use Life Care Funding and why we've been growing all these years is because the costs of care are expensive. As you know, being in the business, assisted living, home care for the most part is a private pay environment. It can be very expensive and difficult for families to manage. Nursing home costs are extremely expensive because it's a skilled care environment. Medicaid and Medicare will cover those costs, but private pay is also accepted and a form of care in a skilled nursing environment, but a very expensive option, obviously. What you deal with is the same thing that we deal with when it comes to working with families and consumers, and that's the level that they are misinformed and unprepared for handling long-term care costs and services. You have a huge population of baby boomers that are turning 65 every day. A vast majority of them will need some form of long-term care services. Much of it will be in a skilled nursing care environment in their lifetime. But too few of them are preparing, planning, and even understand the differences between nursing homes, assisted living, the differences between Medicare, Medicaid, what's private pay, what is covered, what isn't. It's a confusing scenario. Families, for the most part, are ignoring it and don't deal with it until they're in a crisis mode. Oftentimes, a loved one sitting in a hospital bed with all the members of the family looking around at each other saying, now what do we do? Well, for many families, Medicaid, it becomes the option that they turn to. And Medicaid in this country has become the default payer of long-term care services. Families would prefer to be private pay. They don't want to go on to Medicaid. They'd rather be in a position to choose the form of care they want, to not be a financial burden on their loved ones or on taxpayers. They don't want to be a ward of the state and put into a nursing home. If they have the option to be private pay, they'd rather do that. Now, for those seniors who own a life insurance policy, that is one of the disqualifying assets for Medicaid eligibility, and many will end up disposing of life insurance policies as part of their Medicaid planning process. This brings up an important point to be sure you're aware as advisors of liabilities that are out there in the market. One, the fact that there's a federal mandate that states need to initiate asset recovery action against families if there are assets available, such as a life insurance policy and any death benefit that a family might collect. If they hold on to a policy and go on to Medicaid, asset recovery actions are mandated in the states, and states are recovering hundreds of millions of dollars every year from families who did not go about their long-term care planning effectively enough. On top of that are filial responsibility laws that are in over half the states of this country that will hold extended family members responsible for the costs of long-term care. And it's important that advisors are aware of this, because what's happening is, as families are being held responsible, they're turning around and looking at their advisors and holding them responsible. Couple cases in point. Just a couple of years ago, there was a situation in Pennsylvania where a family was forced to cover their mother's costs of staying in a nursing home she had moved into, was there 6 months. Her Medicaid application was denied. She moved out without paying her bills. They took the extended family to court, discovered the son was the most financially able to cover those costs, and he was forced to pay $93,000 to cover his mother's unpaid bills. In California right now, there's an active class action lawsuit that has been filed. It was filed at the beginning of this year by a family who had a life insurance policy that they partially surrendered because they couldn't afford to keep paying the premiums, and they weren't told that they had other options that they could have done with that policy, such as settling it and or using it to pay for long-term care services using a long-term care benefit plan. They are suing the advisors. They are suing the insurance company for millions of dollars in damages because they were not informed of their options thoroughly enough, and they acted with not enough information, and the court is now determining if that was not in their best interest and if there is damages. These filial responsibility laws are on the books, as I said, in over half the states in the country. I'm not going to go through these. I just want to give you a sense of how many states have precedents on the book to initiate these kinds of actions against families and advisors who are getting swept into the mix as well. Now, for long-term care funding, the absolute goal of long-term care providers, as well as governments and families, is to be private pay if at all possible. And there are a number of options that are being used out there in the market. Some of these you're probably familiar with, such as the VA aid and attendance benefit, SPIAs, forms of annuities, reverse mortgages, senior-specific loans, long-term care insurance mitigation, and also the long-term care benefit plan. And that's what we specialize in and that we're going to be spending time talking to you about today. And it all starts with the basic legal premise that a life insurance policy is the personal property of the owner. It has been established through Supreme Court case law that the person who owns a life insurance policy owns an asset, and they have property ownership rights with that asset that are no different than if you own a home, stocks, bonds, any form of asset. Life insurance is recognized as the same as any other type of assets, which gives you the ability to do a number of things. Now, for seniors who own life insurance policies, too many are abandoning those policies. They have limited options to access the value that is in a policy, its inherent value. A disproportionate number of policies will lapse before they ever pay out a death benefit. For seniors, they're oftentimes struggling with a couple of scenarios. One, can they afford to continue paying the premiums? And two, are they looking at the Medicaid qualification situation around a life insurance policy, and are they going to surrender or lapse that policy? For seniors who own life insurance policies, you have upwards of $500 billion a year in the hands of seniors that may lapse those policies without realizing that they have other options, a better solution to use their policy. And when you look at such a large population of seniors who also need long-term care services, 10+ million Americans a year who are accessing long-term care services, that's a very large pool of assets that are owned by a very large population of seniors with long-term care needs. They have a much better option to use that policy by converting it into a long-term care benefit plan. Now, this is a specific way to use a life insurance policy to address an immediate need for care. So the program's been designed to be a simple, quick process for a family to access and enroll. It takes about 30 days, anywhere between 30 and 60 days, depending on how organized and responsive a family and their advisor is to the enrollment process, but it's designed to move quickly and at no cost to the family to enroll. Once they've sold their policy to put together the funds that go into their long-term care benefit plan, those funds are deposited into an irrevocable FDIC-insured bank account. That account holds the funds in a protected account that will be used to make automatic monthly payments directly to whatever provider of long-term care that they choose. Now, these monthly payments can be adjusted so they can address changing care needs as a situation develops. Some families might start out with home care and the need to cover $1,000 a month. A few months later, as their situation gets more serious, they might need to move into an assisted living community that costs $5,000 a month. Well, with just simply 30 days notice, that the amount and the recipient of the funds for care can be changed. The account also holds a cash funeral benefit to help the families after their loved one passes on. And if a loved one passes on while there's still an account balance, in let's say half the account is still there unspent at the time that someone were to pass away, that transfers over to the family. Whoever has been named one or more account beneficiaries will receive those funds. And in fact, because the funds are held in this irrevocable account and used only for long-term care services, it actually is a tax-exempt account. The money being spent on long-term care is tax-exempt, as well as being Medicaid qualified. So this is a Medicaid qualified spend down of those funds. Important to note that the family who uses this benefit program is in no way jeopardizing their future Medicaid eligibility, and in fact, when they're done using the account, it is a seamless transition from being on the account to going over to Medicaid. This is also a qualified benefit to use in conjunction with anybody who's using the VA Aid and Attendance program as well. So it is important to note that this, above all else, is keeping a family, this loved one, private pay, which is putting them in a position that they can choose any form of care they want. This is a benefit that is accepted by every care provider in the United States, and a family can choose what form of care they want and be able to establish what the monthly benefit is for their care, because it's their money in their account, but it's protected and held to be only used for long-term care services. Now, this program is accepted by and endorsed by literally thousands of care providers around the United States, accepted by all care providers across the country. And here's a small sample of what are known as trusted partners for life care funding that we work with, who use this program in their communities or in their home care franchises to help families pay for care, and who work with us to team up with agents and advisors in their areas to help them access and use this program to work with families, referring families back and forth so that they can help them access this program and other services to help them pay for long-term care services. Let me take you through a couple of quick enrollment examples so you just have a real-world feeling of families who've actually used this program. Here's a situation where you had an 86-year-old gentleman with a $90,000 universal life policy. Now, there was no more cash value in the policy because that had actually been used to keep it in force, and premium payments had drained it. The family did not want to continue making those premium payments after the cash value was gone, so they were going to let this policy go. But then they discovered that this was an option that they could access. They were actually told about this by an assisted living community that they wanted to move into. So they enrolled in the program and were able to convert their $90,000 policy into a $31,500 long-term care benefit account. From that, they were able to use $1,800 a month that was paid directly to the community to make up for the balance that they were coming up short for the cost of being in there on a monthly basis. The account also held a $4,500 final expense benefit to be issued to the family after their loved one passed. In this second example, we had a younger gentleman, a 70-year-old male, who had a $250,000 term life policy. Now, this was a non-convertible term life policy, and the family could see clearly that the premiums were going to start getting much more expensive, and they had decided they weren't going to pay premiums and let it go. But before that, they had discovered, actually by talking to their agent, that this was a program that they could access and use it to keep their father at home. They wanted to keep him in a home care environment. So they enrolled in the program and took their $250,000 term life policy that they were going to allow to lapse, and they converted it into a $150,000 long-term care benefit account. From that, they took an initial drawdown of $30,000 that was used to work on the home, put in a safety ramp, safety handles and rails in the bathrooms, and the family purchased a specialty bed so that their father could remain in comfort in an appropriate clinical bedding in his bedroom. They hired skilled nursing care 24 hours to work with him at home, and over the next few months he was able to stay at home and get the very best of care. Unfortunately, he did pass away, though, before he had used up all of the account. There was about $75,000 still sitting in the account when he passed, but that did go to the family it passed to the family. His two daughters were named as the account beneficiaries, so they received actually a partial death benefit, which otherwise they would not have received if they had allowed that policy to lapse. I want to just point out the regulatory structure for this program. One, the policy transfer itself, as I said, the family is going to be selling their life insurance policy. They're going to be selling it for its present day value. And from those funds, that is what is used to fund their benefit account. Based on the fact that the policy ownership is transferred, the program adheres to the secondary market regulations that govern the life settlement marketplace in all 50 states. Where there is regulations, it's a state-by-state regulatory structure. On the benefit account side, it is a benefit account that's held by a nationally chartered bank and trust in Delaware, so the benefit account itself adheres to banking regulations. And as I pointed out, the use of funds, because they're held, protected, and only used for long-term care, the use of funds adheres to Medicaid regulations, making this a Medicaid qualified spend down. This is available in all 50 states. Now, I did point out that this is regulated by the secondary market standards that govern the life settlement marketplace, and there are some differences between the long-term care benefit and the life settlement world. One, Life Care Funding itself is not a life settlement company. We're a long-term care funding company, but we do adhere to the necessary life settlement regulations in the states, but there are some differences. The types of policies that can qualify to be used for this program is much broader. You can work with a term life policy, a universal life policy, a whole life policy, a group life policy, FEGLIs. Any form of life insurance will qualify to be used for the long-term care benefit program, and there's no age minimum. This is purely based on health needs and the need for long-term care services. The size of policies can go much smaller. You can go as small as a $50,000 death benefit with a much higher average payout than the average payout for the life settlement market, and that's because the underwriting is done quite differently for enrollment in the long-term care benefit. It's an underwriting program that focuses on morbidity and mortality and the need for long-term care services with actual long-term care medical professionals who do the underwriting. So it is a much different curve and a much different underwriting outcome. And the process itself, the underwriting process and the application process, is much simpler. It's a simple application, a couple of pages and a couple of authorizations. The underwriting is simplified underwriting, really just reviewing a couple of years of APSs, a phone interview to determine care needs, care budget, just conferring with the care provider and the family to get all that in place. And the processing time is much quicker. This moves, as I said at the beginning, in a range of 30 to 60 days because it's designed to meet immediate need for long-term care. And then, as we pointed out, in most cases, this is a tax-exempt transaction because the funds are being used to pay for long-term care services. Important to note, there's very specific statutes that we've analyzed and worked with a premier law firm to analyze the tax nature of the benefit account as well as the Medicaid status of the account to determine and confirm the status as we've described it to you. Now, on the government relations side, there's been a lot of attention that's been paid to this program over the last few years because states in particular have looked at this as an opportunity to help citizens in their states stay private pay longer, choose the form of care they want, and delay their need to go on to Medicaid, obviously saving taxpayer dollars. If you can delay somebody's need to go on to Medicaid, that's an instant saving of taxpayer dollars. So going back to 2010, the National Conference of Insurance Legislators, NCOIL, actually developed a model law that was introduced across the country to make sure that consumers were being informed of their options if they own a life insurance policy other than just lapsing or surrendering it. Many states have picked up on that model law and have actually introduced consumer protection disclosure laws where the Medicaid departments in their states are actually now being granted the authority to tell consumers that this is an option, that they can use a life insurance policy to stay private pay and delay their need for going on to Medicaid. This has been introduced in over a dozen states now and passed into law in both Texas and Kentucky, and I'd encourage you to take a look at that because with that kind of precedent now, that kind of legislative political endorsement and support for this approach, it's a very powerful tool for agents and advisors when they're talking to families about this as an option. Also, let me point out that the insurance industry leading trade group itself has spoken out publicly and does not oppose the use of life insurance policies to pay for long-term care. They've been very specific about this program, saying that they would not oppose the conversion of life insurance policies, the use of life insurance policies, by turning them into long-term care benefit plans. And in fact, they even played a hand in drafting the disclosure legislation that's been introduced around the country. Many advocacy groups, consumer groups, political leaders around the country have spoken out in favor of this program and this approach. You've had AARP, you've had the American Healthcare Association, you had political leaders all speaking out in favor of consumers being informed of and using this kind of an approach to extend their ability to remain private pay and choose the form of care that they want. This has also attracted a lot of positive attention in the press. This has been written about in the New York Times, the Wall Street Journal, USA Today, countless radio programs that have covered and done programs on this particular way to help families pay for long-term care. So when you or families are looking at this and Googling this, looking things up, you're going to find a lot of great information, a lot of great support, positive stories about this approach to paying for long-term care. So who benefits and how with this program? Well, I like to point out that there's really three big winners here. One, first and foremost, the consumer, because they're converting an asset they already own, that they've been paying premiums on for years. I mean, we talk to families that have been paying premiums sometimes for 20 and 30 years when they come to finally discover that this is a program they can use and an approach to help them pay for long-term care, as opposed to just abandoning the policy, putting them in a position where they're financially independent, they're making choice, they're maintaining dignity, and using an asset they already own to pay for their care. For the providers of long-term care services, this is an important added way to help bring private pay dollars into the system. They work on very tight margins, so the more private pay you can bring into the system, the better the quality of care is for everybody. So the providers of long-term care services out there really appreciate working with agents and advisors who use this program, because they see a clear-cut way to bring more private pay dollars into their communities paying for their services. And then last but certainly not least is the Medicaid budgets that are under tremendous stress. And then you and I, all of us on this call and everybody else, we're all taxpayers. We pay for Medicaid. We pay for these services through our tax dollars. So anything that we can do to help save those dollars, delay the need for Medicaid by encouraging people to be using private pay sources, is best for everybody involved. Now, agents can use this program, and this is my last slide before we move over to Q&A, so if people have some questions, start thinking about questions that you'd like to type in, and we'll address them over the remainder of today's session. But let's start out just by pointing out agents can be contracted to work with this program. There's a very specific contracting packet that if you're interested will be sent to you electronically. It's a simple application. It's going to that you'll fill out. You'll be confirmed of licensing statuses, and if approved, you actually will have E&O coverage issued as part of your being appointed to use the program. You then will have access to a passcode protected website portal where you'll find private label marketing materials that can be customized with your logo, your information, flyers, educational materials, PowerPoints, video. There's a number of different things that you'll have access to that you can use, and will help not only inform you, but inform your customers of this as an option that they can be using. Also, as an agent working with the program, you're connected to these trusted partners. We're going to introduce you to the assisted living communities that are in our network, the home care companies, the nursing homes in our network. We want you to be working with them. We want them to be reaching out to you, and you collaborating with them and us to help families use this program and any solution to help them afford the cost of long-term care. Lastly, let me just point out that compensation is available, and it's based on the policy face amount of the policy itself. So if it's a $100,000 policy, the compensation is based on that $100,000 death benefit. And that's available for licensed producers, again, regulated at the state level. And there are also certain exemptions in place for other regulated classes of advisors, such as CPAs, financial planners, attorneys, and the like. So I'm going to stop there, and I'm going to turn now to taking a look at any questions that have come in and do my best to address them in the remaining time we have on our call. So give me a second as I pull those up. All right, I'm going to start scanning down now through these questions. One asked if we can send the filial states list out. You know what? This entire presentation and PowerPoint is going to be on the 3 and 4 website. It'll be posted, I think, as soon as next week. So you can go back to that to grab whatever you want. But you can also feel free to email or contact us if you want anything in addition. We'd be happy to send it to you and share with you anything that you'd like. Next question is, does this program apply to somebody who's no longer paying premiums on a life policy because of a waiver of premium for disability? Absolutely. This will absolutely apply to somebody in that circumstance. Let me point out again that the pricing of to determine the present day value, that conversion value of the policy, it's underwriting that's looking at the policy and looking at the health conditions of the individual. So it is not a cash value scenario. This is purely based on the death benefit of the policy. It says next question says, when you say the funds go to an irrevocable account, which funds are you referring to? The cash value in the policy or the face amount of a policy? We are referring to the value of the policy based on its face amount. So to give you an example, let's say it's a $100,000 life insurance policy, and it's determined that based on the policy parameters and the individual's health care situation, they would qualify for a 50% conversion. They're going to get $50,000 that's going to go into their account. Let's say that policy had $10,000 of cash value. Well, that's not a factor in this. Instead of surrendering the policy for $10,000, they're taking $50,000. It's going into their account, and it's being held and used in the account for long-term care. So in that circumstance, if all the money is being spent on long-term care, that's $50,000 of tax-free money. This is the kind of question we always love to answer. It says, this is a great presentation. Can we as agents get a copy of this PowerPoint and give this presentation to groups? Yes, there is a version of this presentation and other information that you as agents, when you're contracted and using this program, will have access to. A whole host of materials are made available to you that you'll find to be pretty impressive. You'll get a sample of, a hint of what much of that is on the Life Care Funding website. And that's, as you see here on the slide, lifecarefunding.com. And we're happy to make all of that available to you to use. Is the account subject to the 5-year look back? Well, it is, but let me point out, it is a qualified spend down. So while the person is using the account, they're not on Medicaid. They are private pay. So what families do when they're using this program is they don't apply for Medicaid until they've spent through the account. They get down to the last 90 days, and then they move forward to applying for Medicaid. Medicaid will look at the account, the use of funds, how they were obtained, and that they were used to pay for long-term care, and it's an automatic Medicaid qualified spend down and will not cause any delay in their Medicaid eligibility whatsoever. Another one says, Chris, I have read your book, or my book, Help on the Way, and cannot wait to get through my state's licensing compliance and start making your program available to my clients and prospects in Idaho. Well, we're looking forward to working with you, and as soon as you want to get started, we will get that contracting packet right to you. Another question, how is E&O provided at no cost? Once you're contracted, it's a blanket umbrella policy that is you are covered by only for this program. This does not replace your current E&O coverage and for other products. It is coverage strictly and only for those who are offering this particular program. I'm just reading through this question. Give me a moment. When transitioning to Medicaid, does the final expense piece stay in place, or does it go away when the spend down is completely accomplished? The account will remain open with that last little bit of final expense funds, which is 5% of the death benefit or $5,000, not to exceed $5,000, which, because it's held in an irrevocable account and can only be used for final expense purposes, states recognize it in the same way they do a funeral expense policy. and that's why it was set up the way it was. State political leaders really wanted to see that in place. Long-term care service providers really wanted to see that in place. And families really wanted to see it in place, and so did we. It's been a feature of the benefit since the day it was launched in the market years ago. It says, do I have to have a life settlement or viatical license / endorsement in my state to participate in this program? This is, as most insurance products are, regulated on a state-by-state basis. So different states regulate the life settlement / viatical world in different ways. Some states don't regulate it at all. Some it's a simple endorsement. Others it's a license. And when you get your contracting packet, there is a state-by-state matrix that lays out each state's requirements so that you can quickly look at, refer to in your state, what will be necessary to be in compliance. Where does one get the contracting kit? All you'll need to do is submit your request for it, and we'll make sure that it is sent to the group that administers contracting and working with agents. You can just send it in. You can just send an email to info@lifecarefunding.com, and that will go to the appropriate person to make sure that your contracting kit gets sent right out to you. And again, if you have further questions, don't hesitate to email me, call me. I'm happy to talk to anybody about this at any time. The next question is, what is your email address? My email address for everybody is CORESTIS, CORESTIS @lifecarefunding.com. You can also use info@lifecarefunding.com, and if it's something you want me to address, it'll get to me. I did mention, question is, can FEGLI policies be used for this program? And the answer is yes. It's not an easy process, and that's why in the life settlement marketplace, that's not a form of policy that's accepted. But we do work with FEGLI policies. We've worked with them, and they are an accepted form of insurance to enroll in this program. Who continues making the premium payments on the policy after it's been converted? LifeCare Funding is actually the company that is going to continue to administer and hold interest in the policy. We are a buying entity. We do the funding, and so we will have an interest in the policy, and we will continue to make the premium payments and keep that policy in force. How do you as a company make money? We retain an interest in that policy, so when the person passes away, the full death benefit is being collected by a third-party entity of which we have an interest in, and our compensation, our cash flow comes from having an interest in the policies when they pay out in the future. Somebody says, is there room in a $100,000 term life policy to do anything for my client? Well, the answer is very much a possibility, yes. Every case is taken on an individual basis. We have to look at the policy. We have to look at the individual, their need for care, their health situation, the premium payments. But once we look at all that, absolutely, in fact, policies in the range of $100,000 to $300,000 are the most common size policies that we see. It's a range of $50,000 is the lowest to $1 million of death benefit is the highest, and the typical range of payout for the death benefit in terms of funding the benefit account is a low of 20% to a high of 60%, sometimes even greater, depending on the healthcare situation. Can the money in the account be used for other things? It can, but they have to be long-term care related other things. It can't be used to go on a world cruise. It can't be used to buy Junior a new Mustang because he's going to use it to drive Nana around to her doctor's appointments. It has to be used on legitimate long-term care expenses provided by home care environment. It can be provided by a skilled or non-skilled home care provider. It can also be provided by family care providers, assisted living, skilled nursing, memory care, hospice. If somebody's staying at home, there can be use of funds to help get the home appropriately situated to provide care in a home-based environment. There are a number of uses, and it's designed to be a very flexible account and a very flexible program, because people's long-term care needs are varied, and the situations can change quickly. This is not a rigid, this is what you get every month, and if you don't fit this tiny box, you can't get your money. It's used to pay for long-term care services and adjust to the changing care needs of the individual who has the account. Reading down through the questions. Oh, thank you. Another that's a nice compliment. Wow, such a great presentation. I can't wait to tell my clients about this. Thank you very much. We can't wait to be working with you. Can someone convert a policy even years before the need for LTC? I am glad you asked the question, and unfortunately the answer is no. This is a tool to be used for immediate need for care, and we run into this situation. Families will contact us, agents will have a case where the family says, we're starting to prepare for long-term care. We think it's another year or two in the future, but we're going to let go of this policy, so we'd like to enroll now and have the account sit there, and if we need it over the next couple of years, we'll start using it. We're not able to accommodate that kind of a situation. Typically, the need for care has to be within a 90-day period. A lot of the people that we work with are already receiving care, or but for the fact that they can't afford it, would be receiving care. Now, what we do see happen in such situations where somebody's not quite ready and they're trying to figure out if this is a way they can do something to prepare for the future, is they'll hold on to the policy. They'll keep it in force. They won't let it lapse. And I can tell you, this happens a lot. We'll talk to somebody who says, it's a couple of years away, but, thanks for letting us know about this, because now we're going to hold on to the policy. We're not going to lapse it. 3 months later, 6 weeks later, we get a phone call. Oh, no, things have just gotten much worse. Mom fell. It's escalating. We hadn't seen her in 6 months. We just got together for Thanksgiving. Believe me, our phone's been ringing off the hook. And things are much worse than we thought. We need to use your program now. Thank you for having told us to keep this policy in force, because now we have a tool to be able to address what we didn't understand was an immediate need for care, and all of a sudden is. Can the fund be increased by using other assets and combining it into the account? No, the fund only really can hold these funds from the insurance policy conversion. You couldn't take other funds and tuck it into this account. Any other funds would have to be held and used separately. How does a group life policy work? How does a term policy work? Well, we've done a number of group life policies, and group life policies, they're all different. Group life policies are like the Star Wars bar of life insurance. There's all sorts of types of them. You almost never run into the same thing twice. But we do work with group life policies and have encountered just about every situation you can imagine with a group life policy, and we're able to make it work. On term life policies, again, it's a matter of the care needs, the remaining life expectancy of the individual, and what the parameters of the policy are and how expensive it'll be to keep it in force. If it matches up, then it'll work and somebody can use it. We've had situations where it isn't going to work, and unfortunately we would have to decline the application. But very often a term life policy will work as long as the care needs there. That's the real key, is the immediate need for care. If somebody doesn't really need care, but they're just trying to figure out how to get something out of a life insurance policy they are otherwise going to dump, they might want to explore just the traditional life settlement market. But if you have an immediate need for care, and the goal here is to fund care and do it in the most efficient way possible, then that's what this program is designed to do. Do you work with survivorship life policies, second to die policies? Unfortunately, we do not. That is one form of life insurance. It's just not, it just doesn't work in this environment. Can a family member be paid for caring for a loved one? They can, but it's a very it's handled in the same way that even Medicare and Medicaid looks at family caregiving. There has to be a certified doctor's plan in place. Funds can't be commingled. This is a very much a verified use of funds to pay for long-term care services. So when a family member is giving that care, they're looked at, treated, and held to the same standard as a professional long-term, third-party long-term care provider would be. Next one, thanks. This seems too good to be true with a big smiley face next to it. I'm a captive agent. Will you work with agents like me? The answer is yes. We're happy to work with any agent, an agency out there. The question would be for you, will the carrier that you work for allow you to use this program? What you need to always be cognizant of is, because it's regulated as a life settlement, as part of the transaction, that underlying piece of the transaction, there are some broker-dealers, there's some carriers out there that may prohibit you from using this. You would have to check with your hierarchy to determine if this is something you can work with. But we would be happy to take on any agent who has interest in using the program and applies and approves to be appointed. What if the person dies before using up all the funds in the account? Any balance in the account is going to be paid out to whoever they've named as the account beneficiary, and they can name one or more people, and that transfer to account beneficiaries can be tax-free as long as the family member receiving it is underneath the estate tax threshold of about $4.5 million. Then they're receiving this as a tax-free death benefit. Good question here. Is the money that goes out every month given to reimburse expenses, or does it pay for expenses that are due in the present or in the future? Great. I'm glad you brought up that point. This is not an indemnity program. This is not back paying for expenses incurred per month, where somebody would submit a bunch of receipts and one month they needed $1,284.72, and the next month $1,400.37. What we're doing is we're looking at the care plan, the care needs with the family, and establishing what is that monthly budget. Is it $2,000 a month? Is it $5,000 a month? Is it $1,800 a month to make up for a gap in their ability to afford care? Is it $5,000 a month to cover the whole knot? It can change if they move from one care provider to another, if care needs become more significant, but there is a monthly budget established that it pays out against, and with 30 days notice, though, that can change to reflect any change in care needs. What's the conversion rate? Well, as I pointed out, it's a low of 20% to a high of 60%. The average conversion rate in our experience has been in the neighborhood of 40–45% of the death benefit. All right, I've got 3 or 4 more questions here. And we have about 10 more minutes to work with, so I think we can work our way through these just in time. So, does this program help protect other assets during a spend down when qualifying for Medicaid? That's a great point, because a lot of families, what they'll do is they'll use this program and preserve other assets. So instead of selling off a home, selling off a camp, selling off other assets, first they'll use the life insurance policy and stay private pay, delay their need for going to Medicaid. If you're not on Medicaid, then you're not responsible for Medicaid eligibility and its requirements. Now, if the plan is to become Medicaid eligible, then this is a Medicaid qualified spend down. It's a bridge to get you there, but your other assets would have to be dispositioned correctly. But for many families, they will look at this as the asset they would rather liquidate and stay private pay and do it in a Medicaid qualified spend down, while hopefully protecting all the other assets from the need to spend down and get rid of them. We have one group that says we are licensed brokers that focus solely on long-term care planning, and we partner with CPAs and elder law attorneys. It would be interesting to present this to them, those that we work with, and see if they can sell these themselves if they want to. Yes, you can partner with, and they being exempt, in fact, from the life settlement regulations, they have the ability to charge their clients for offering this as part of their services. So as a licensed agent, you can receive a commission, and as an exempt entity, such as a CPA, a CFP, or an attorney, they're able to charge their clients a fee for the service of adding this to the mix of their long-term care planning solutions. Another compliment. Thank you for the compliment. Does the good last question here. Does the remaining balance at death become subject to estate recovery? Well, the answer is an emphatic no, and that's because as long as they're on this program, they're not on Medicaid. So there's no asset recovery exposure if you're not receiving Medicaid supports for long-term care. If you're on the long-term care benefit plan, you're private pay, you've chosen the form of care you want, and you have not yet gone on to Medicaid. Now, you're cognizant of the potential for Medicaid in the future, and by using this, you're Medicaid eligible in the future. But if you're on this program and you pass away, the funds are not subject to asset recovery, and in fact, they will transfer over to whoever you've named as your account beneficiaries. So what you've really done is actually paid for your care using an asset you already own, and you've managed to preserve some of the death benefit in the process for loved ones in case you do pass away. Well, that was the last question, and with that, I'm going to thank all of you for joining us. And again, please reach out to us with any additional questions. We're happy to share information with you. This will all be posted on the 3 and 4 website. I want to thank Jonas and all the 3 and 4 for their support and working with us to put this presentation on. I thank you all very much and appreciate your attendance today.